Hello, this is Brian Shannon from AlphaTrends.net. It's Thursday, the 24th of July, 2008, and looks like the buyers had their chance to hold on to gains, but were unable to do so. The S&P 500 lost 2.2% today with its nearly $3 loss, and you can see we are back below the lows that we've seen earlier in the year, mid-January and mid-March. So that puts the sellers really probably in a more confident position once again, and we do have a declining 50-day moving average. I was thinking that maybe this rally was going to turn into something a little bit more than just the 38.2% retracement, but and that's about where it stalled intraday yesterday. I was thinking maybe we would have a chance to continue up towards the 50% retracement after some consolidation. But sellers came in with a lot of conviction here today, and as the market broke below yesterday's lows, and then it continued lower from there. Paused slightly at that rising 5-day moving average in that 126.5 area, but couldn't hold on, and the sellers drove it down to the lows throughout the day here, as the market remained below the declining VWAP all day, meaning it just didn't make sense to be there was no advantage rather to being a buyer in here today and fighting the steady downward pressure all day long. So we're back to the lows from January and then March. So again, we've got to be very careful in here, and we remain in a primary bear market. As I said in my book, I think the definition of a downtrend is a market where you have a declining 200-day moving average. That's the definition of a bear market in my mind, not this down 10% or 20% or whatever, but below a declining 200-day moving average. And it's going to take a lot of time for this market to heal properly, for that thing to flatten out, and it's going to take at least, I'm just guessing here, 6 months or so. But the path of least resistance is lower. If this market can somehow hold above 125, we'll save a disaster, I think, for now. But I think the more likely scenario, just based on the path of least resistance being lower, is that maybe we consolidate above that 125 level and then go back down and test these lows and maybe drive to new lows as well. So you've got to be very quick. You've got to be decisive in this market. You've got to be a trader. There's not really an advantage to being an investor in here, because things move so quickly. They hold on for 3 or 4 days, and then you just they give everything right back. So if you're not an aggressive and disciplined trader, I think that's something I've said more consistently than anything over the last 6 months, 9 months. Then you probably should just be involved from a spectator's point of view more than anything. So oil continued lower for part of the day, but did finish with a gain of $1.05 here today on the USO. It didn't do anything to break this short-term downtrend though. And yesterday I was saying, if you did get short, you wanted to use that definition of lower highs and lower lows. Well, I think now that basically you could say at about 102 or so is where you would want to cover any short positions if you have one. But it's good to see that oil continues lower. It didn't seem to, well, it was up today, but that this trend here is lower. Natural gas is the one that really continues to get hit, and I said, you might want to begin to look for a reason to buy based on the fact that it's near that 200-day moving average. But yesterday, since it closed right on the low, I said the word, nothing there to suggest the buyers were showing up. And in fact, today we saw even more selling in here on just massive volume. Look at the volume of this UNG, probably the biggest since this came public. And there's a lot of reasons to think that it should bounce in here. You could look at Fibonacci, you could look at that 200-day moving average. But the point is, only price pays, and when prices are declining like this, it makes no sense to be a buyer. You can look at it and say, well, big volume, maybe that's the low, and maybe it is, but this market still needs to heal before it can be considered something worth consideration for buying. So UNG continued to just watch the carnage and stay on the sidelines there. The IWM lost $1.72. Yesterday I said that it came to an area where I'd expect at least a little bit of consolidation, if not a little profit taking, because it was this prior level of support that had been broken in the area where we were kind of between the declining 50 and 200-day moving averages. I was saying in here that it looked like we had our first signs of a potential problem. It didn't look like there was any reason to sell short, but I said that we have this high and a lower high. If we were to break below here, that it would create a lower low, and breaking below that 71.10, and I thought maybe it would head down towards that 69.5 level. So it didn't quite make it down to 69.5. We still are near that 5-day moving average, but just based on the overall uh, just bearishness of the longer term trends of this market, I think you got to be very careful. If you're still holding your long positions in here, you want to be thinking very carefully about where you want to get out. And maybe we get a bounce up towards this level. If this level becomes resistance, then I think it's probably a good time to start looking very aggressively at the TWM. The TWM, of course, is the double inverse Russell 2000, and that was up 4.7% today, with the 2.5% decline in the IWM. But the Russell 2000 has been the leader on the way up, but it came right up to this prior level of support. Now we're finding that it has in fact found resistance here. The next best level of support looks like this 68 level that was so important on the way up. So be careful in there. Financials. Yesterday they got up to that declining 50-day moving average. I thought it was early to be a short seller, but in fact what happened here was kind of the same thing as the IWM. This would have been the place to sell short if you were getting short based on the longer term trend, because here we see we have this low, we have a lower low, this high and then a lower high, and then we had this low, and this is the level that breaking, I thought yesterday, might lead to the next leg lower. It's still tough to say whether this market is going to cave in completely and drop down towards the lows that it's seen back towards 17. That's still quite a bit away, but I think a test of 20 looks reasonable at least. So be very careful in there. That's also where we have the 10 and 20-day moving average. So we're just seeing this volatility kind of come back in the other way right now. And I think the biggest reason for concern about the Nasdaq 100 is the semiconductors. The SMH continues to break down in here. I haven't been talking about these much recently, but I was looking at them today and figured that I needed to mention them because we're right down near the year lows in here on the semiconductors, and they look like they're still heading lower and probably due for at least a test of this low and perhaps even continue lower. You'd have to look at a monthly time frame to really see where the next potential levels of support are. So here's where we are right now, right about that 27.5 area, which was a low from 2004 and then tested earlier this year. So breaking down further here in the semiconductors could be further trouble for the SMH, for the Qs rather. The Qs have been really kind of in this range of 44 to 46 is really what has been doing, and the consolidations, we've been looking at the potential for an inverted head and shoulders pattern. Now you can look at these patterns and say in the only reason to ever participate, you can look at this and say, well, there's a potentially bullish scenario, is this inverted head and shoulders pattern. It has to complete the pattern and make that higher high after having a higher low. So yesterday I'd said that basically, if we could get back above 46, that's a good sign for this market. And I had said that this is really where the big level is going to be for the real danger, where we could kind of just see the market cave in as a break down below $44 a share. But to be more aggressive and where to get defensive would be a break below this low right here at 44.75. We had that level get violated here late in the day after holding up for much of the day. And here's this 44.90 is really where this last leg lower came in. But here's that 44.75 level. We're below it, so you've got to be very defensive in here. I think that again, it's range bound, but the consolidations within a range typically resolve themselves in the direction of the primary trend. Obviously, that's lower.